General Mills has fallen by 46% from their all-time high, which has led to an amazing dividend yield of 4.9%, which is near a 10-year high for General Mills. Better still, they're trading at a PE of just 11.9, while the S&P 500 is at a current PE ratio of 27.2. Today's video will be an in-depth analysis of General Mills stock, covering business operations, fundamental, and technical analysis. General Mills is a packaged food company who advertises themselves as an international company, stating they operate in more than 100 countries, which might lead you to believe they're something like a Coca-Cola. Although this is a little bit of a misrepresentation of their business, as the vast majority of their revenue is derived from the United States, coming in at 81% of sales. And by operating profit, the international segment only represents 3% of total operating profit. So they are primarily a domestic food company. Another way they categorize their business segments is by these four operating segments, with the largest being North America Retail at 61% of revenue, which sells products to retailers like grocery and convenience stores. And they produce products mostly made from cereal grains, which are wheat, oats, and corn. They have some popular brand names like Betty Crocker, Bisquick, and Cheerios, which I found out was originally called Cheery Oats. Otherwise, they have many other brands that you may be familiar with. This segment is their largest and therefore most meaningful segment, and has shrunk in terms of revenue year over year by a rate of 5% due to declining product volumes. Their next largest segment is international at 14% of revenue, which has some of the same brands as in North America, but just fewer of them, like Betty Crocker, Cheerios, Green Giant, and Haagen-Dazs. And this segment grew year over year by a rate of 2%. Next, we have North America Pet at 13% of sales, which has some notable brands like Blue Buffalo, which offers dog and cat foods and treats. And within the last 5 years, they've acquired 4 other pet brands, with the most recent and largest being Whitebridge Pet Brands, valued at $1.5 billion. This is their fastest growing segment, which grew 4% year over year, and it should continue to grow due to their recent acquisition. Their smallest business segment is North America Food Service at 12% of revenue, which sells the same types of products we've discussed, in addition to raw ingredients required for baking. And this segment sells to consumers in food service, vending, and supermarket bakeries. And this segment grew 2% year over year. Now let's cover the macro level pros of General Mills' business. The most obvious advantage to General Mills' business that comes to my mind is that they sell essential goods, which are foods. This is great, especially in weaker economic environments, as people need to eat regardless of economic conditions. And I think the current economy in the US seems fragile. Another macroeconomic condition that General Mills is well suited for is tariffs, being that the majority of their raw materials are sourced from within the US. They won't have to retool all of their operations and product pricing in order to continue selling and producing their products. Like a business like Ford would, for example, who sources a meaningful proportion of their parts and materials from outside the US. The final advantage to General Mills' business is that they are well diversified by product category, offering a breadth of items like noodles, cereals, snacks, protein bars, vegetables, sweets, and ice cream. And better still, they have food for other animals too, through their growing pet food segment. And I think this degree of product diversification makes them even more stable for ever-changing consumer sentiment. General Mills has some positive elements to its business, but there are some major risks to consider. One of them being that consumer sentiment appears to be moving away from many of the products that General Mills sells, since I think they could generally be considered unhealthy, like some of the sugary cereals, for example, and products under the Betty Crocker and Pillsbury brands. Or another consumer trend that could, and probably already has, affected General Mills is being gluten-free. And gluten is a component of wheat, and wheat is one of General Mills' core raw ingredients, which goes into many of their products. Changes in consumer sentiment like this could be part of the reason why their revenue growth over the decade has been slow. Another downside to General Mills is that they are primarily a domestic business, which limits their opportunities of expansion and leaves the investor reliant upon a single market, while other food companies like Nestle are truly global companies and sell food and other products around the globe, which offers diversification and with that, risk mitigation. On the right, we see General Mills' revenue, which has been very consistent, although very slow growing too. at a 10-year compound annual growth rate of just 1.6%, which is more like a revenue decline if we account for inflation over the decade. In terms of free cash flow per share, again, we see consistency, which is great, but slow growth since 2016 to today, with a CAGR over this period of just 2.0%, slightly outpacing revenue growth. The next metric we have is shares outstanding on the left, which to me is always a measure of financial wellness. General Mills had a phase where they were diluting shareholder value around 2020, but they still ended the decade having reduced their share count by a CAGR of 0.9%, and some share count reduction is better than none. Another all-important metric to consider, especially while interest rates are high, is total liabilities plus cash and equivalents compared to free cash flow. General Mills is doing quite poorly by this measure with a total liabilities level to free cash flow of 18.8 times. Or another way we can look at debt is by interest coverage, which divides operating income by interest expenses. And we see the trend is moving in the wrong direction, having started at 9 times and is currently at 6 times, which is below the threshold for what Simply Safe considers preferred. I imagine this debt level is one of the main reasons why the stock has been so beaten down lately. In terms of valuation, General Mills is trading at an objectively low multiple, at a trailing price to cash flow of just 9.1 times, which is a 26% discount compared to their own 5-year average of 12.3. Or if we looked at the trailing PE ratio, currently at 11.9, compared to the Consumer Staples ETF, XLP, at a PE of 23.1, General Mills is also trading at a significant discount to its peer group. Now we can get to the reason why you might be considering investing in General Mills, which is their dividend. They offer a current dividend yield of 4.9%, which is almost a 10-year high for General Mills, and has only been higher around December of 2018. And a 4.9% starting yield is pretty spectacular for a consumer staple stock, and their dividend is growing too, albeit slowly, at a 10-year CAGR of 3.6%, a 5-year CAGR of 4.2%, and their trailing 12-month growth rate is the slowest yet at just 1.7%. Just a quick aside, if you like this stock investing platform and want a discount on the premium membership, I have a link below in the description, and you'd also be supporting my channel. In terms of General Mills' dividend streak, they've proven to have quite the robust business, probably due to selling essential products, with an uninterrupted streak of 127 years, meaning they began their dividend streak the same year that the United States declared war on Spain in the Spanish-American War, although they have a minimal growth streak of just 5 years. Growth streaks can be impressive, but how safe is the dividend based on the free cash flow payout ratio? Over the past decade, their average payout ratio as a function of free cash flow was a conservative 53%, and their trailing payout ratio is only slightly higher at 58%, which is still fairly low, and their dividend is likely safe based on this metric. Here we see a 10-year price chart for General Mills, which is a higher time frame than I typically use. But 10 years of data shows the massive discount that General Mills is trading at based on the average price over this period compared to the current price, with the average price being at $68, while the current price is $49, which is a significant discount of 28%. And better still, this price point corresponds with the bottom of the standard deviation channel, which is often a point of support. In terms of support and resistance, General Mills doesn't have the cleanest price action, but the most prominent and relevant support I could find is around $46. Although I doubt price will go that low without some new and unforeseen catalyst, and the stock looks to be consolidating around the current price level. The last key metric we have on this chart is the Relative Strength Index, or RSI, which shows a very opportunistic buying point, being at this relatively low level of 29. I could see General Mills reversing if the S&P 500 doesn't push General Mills down with it. If you want to see another video of a stock with an uncharacteristically high dividend yield, check out this video covering Target.
I'm not a financial advisor, and this is not financial advice. This is for educational and entertainment purposes.